Okay, guys, so we'll start off with Mia Wong here. The same transaction that was in the slideshow of Chapter 1 is now done in terms of debits and credits. That was Mia Wong. Remember that she invested $6,000 cash and $200 of office equipment in the business. Now, we're going to translate those pluses and minuses. You know you had a plus to cash and a plus to office equipment and a plus to capital. Knowing your rules of debit and credit, the accounts here affected are cash, which is an asset. The rules are to debit the cash account for increases because it's an asset, as is office equipment, also an asset. The debit is made into the account in order to increase it, and the combined total of the debits is equal to the credit, which causes the capital account to go up. So here are your rules of debit and credit. Here are your entries: the debit to cash, the debit to office equipment, and the credit to capital. Another transaction. Bought equipment for cash. Same thing, I believe, from Chapter 1. You already had 200 in there. So what are you doing? You're debiting office equipment again for 500, and you're crediting the accounts B. You're debiting the office equipment account in B. Sorry about that. In B, we are purchasing office equipment for cash. The accounts affected are both assets. It's a shift in assets. So we're going to add to office equipment. The rule is debit to add to the office equipment account and credit to subtract from the cash account. Again, assets are increased by debits and decreased by credits, and that's exemplified here, keeping the transaction strictly in the asset side of the equation. There's a debit to office equipment, which adds to one asset, and a credit to cash, which subtracts from the other. Next transaction. C. More office equipment on account. Asset office equipment is increased. What do? You debit it to add to it. So you can see there's 3 debits already in the office equipment account, so that you're adding them up. At this point, there'd be 7 and 3 is $1,000 of office equipment. Now, you're buying on credit, so that when you analyze the transaction, you realize that you're not paying cash, but you owe for that $300 purchase. Therefore, you need to add to office equipment and add to accounts payable in terms of debit and credit. To add to the asset, you put your debit there, you put your credit into accounts payable to add to that. So accounts payable has a positive balance of $300 at this point. Again, the rules for recording entries using debits and credits are that at least 2 accounts are affected, and there must be an equality of debits and credits. If there aren't, you'll never get your trial balance to balance. Transaction D, legal services for cash, add to cash, and add to revenue. Is that what you did in Chapter 1? Yes. How do you add to cash? Being an asset, it's a debit. How do you add to the legal fees? Being a positive capital item, you credit it. So the entry would be to debit and credit, as you can see here. We followed our rules. At least 2 accounts are affected, and the total debits equal the total credits. Transaction E, another revenue transaction. This one's on account. We did this in Chapter 1. We debit accounts receivable. We don't have the cash, but accounts receivable is an asset, and given that it's an asset and we need to increase the amount owed to us, we debit the accounts receivable account and we credit the legal fees account, which now has an accumulation of $5,000 in it. The rules stay the same. For every transaction, there are at least two accounts, one, two, at least two, and the debits and credits have to equal. Once again, it's up to you guys to memorize, to analyze the transaction first. Ask yourselves what accounts are affected by the transaction. There's an asset account, the cash account, the accounts receivable account, and the revenue account. And what's happening to them? Well, they're both going up. Then you have to translate those pluses into debits and credits. Therefore, you can see the debit and the credit, which are equal. Transaction F, we are collecting our accounts receivable. Remember, the person owes us $3,000 from the previous transaction. It's simply a shift out of accounts receivable into cash. What do we need to do? We need to add to the asset cash. We need to, in order to increase it, because it's an asset, assets are increased with debits. So there we are, debiting the asset cash account. And here we are reducing, because it's an asset. What happens when you need to reduce an asset? You have to enter a credit. So a debit adds to, a credit subtracts from assets. Up to you to learn the rules. Paid salaries. You got a debit salaries expense. Now that's an addition to salaries expense because it's an accumulation. You got a debit salaries expense and credit cash. So you're adding to salaries expense, which ultimately will reduce equity, and you're going to reduce cash with a credit of $700. Okay, that's G and H. You paid your rent, very similar to the previous. Debit rent, credit cash, add to your expense, reduce your cash. The diagram here shows you the types of accounts, the accounts affected, what kind of accounts they are, what direction do they need to move, and how to finish off the transaction in terms of debit and credit. We're gonna pay this bill next month, so that we have to record it as incurred, same as Chapter 1. Debit advertising expense, credit accounts payable. Again, we need to add to the expense. How do you add to an expense? With a debit. We need to add to the liability, called accounts payable. Ledger account number 211, ledger account number 513, debit, credit. Now that we see the accounts payable account, we've got $500 owed. A withdrawals, just like an expense, is debited. Okay, we're accumulating the withdrawals account, so you debit the withdrawals account, take it out of cash. Cash is an asset, so you can see this increase, increase, increase. Had this been in one column, right, there'd be 6 plus 6 minus 5 plus 2 plus 7 minus 7 minus 4. You see what I'm saying? Minus 1. That would all be in one column. But here, when we use debits and credits, the additions are on the left, the deductions are on the right in the cash account, because those are the rules for any asset. Debit to add, credit to reduce. And there is a summary of the transactions. Now, what I want you to look at is the solutions to the problems, the B series problems, which you have. So this is the completed summary of all of the transactions that you just did, and I will anticipate that what he does not show here is he does not show the account balances, but the problems that I sent you will show the account balances. To get the balances of the accounts, you have to add the debits and then subtract the credits. Being an asset, you would normally have a debit balance, and so on and so forth. Maybe he'll show a trial balance, and Oh, here he is. He's now showing, okay, good. So now he's doing what I said that he didn't do. He's adding the total debits and subtracting the total credits, giving the cash account a $7,200 balance. He's subtracting $900 from $3,000 to give that account a $1,000 balance. There are no credits to equipment, so that we have a $1,000, the sum of those three. Accounts payable, there were no payments on accounts, so that we still owe the $500. She's still at 62, and that's 100. There were two revenues accumulated, totaling 500, and the expense accounts only have one entry in them, and those will be carried as such to the trial balance, which you can see. So the same numbers here: 72, 21, 1, and a credit of 5. Quickly: 72, 21, 1, and a credit of 5, and on it goes. So if you flip back and forth between the account balances in the summary. That's your ledger. You flip back and forth, and you see your trial balance. And my friends, that is the objective, or those are all of the objectives in Chapter 2. You have an exercise, problems are due on Thursday night, so get busy. Watch my videos. I don't see too much activity, but I'm preaching to the choir again. Okay, take care.